Hey guys, this is Mr. Roxy coming at you live from Palm Beach in Florida. It is Saturday. It is January the 8th. It's about 8 p.m. in the evening. The markets are closed. There's nothing really going on. I made this presentation I'm going to share with you a few days ago. So don't be too hard on me if some of the information that I share with you is a couple of days out of date. Like for instance, the stock price or something, should you see it. But a number of people have asked me over the past couple of months what I feel about Cenovus. And Cenovus is a Canadian energy company, and I've kind of resisted the temptation to talk about it specifically. And the reason for that is just simply that going back about a decade or so, just slightly more than a decade ago, Canada was one of my clients. And as a result, I knew the company quite well. And of course, Cenovus was a spin-off from Canada. And that's one of the reasons why I kind of had a little bit of hesitation in terms of talking about Cenovus. But anyway, I've overcome that. So what we're going to do today is talk a little bit about Cenovus Energy. And I'm going to give you a little bit of background here very quickly. So every day, every new day SK, which I'm assuming means every new day Saskatchewan, Canada, but I'm making an assumption, I might be wrong, a while ago said, I was also curious on your thoughts on Canadian producers, since with the Enable pipeline coming online, we will now see tighter spreads for Western Canada versus WTI. Producers like Cenovus might become very profitable. They sure are. Brian said, hey, Mr. Oxy, I had a few ideas about getting involved with some Canadian oil sands stocks, given that I feel the current high price environment really favors them. Well, Brian, it sure does. In fact, many of the Canadian oil sands stocks have been performing exceptionally well, and I would not be hesitant to park some money in the Canadian oil patch, regardless of the disruption and challenge that they face with the current Justin Trudeau Liberal regime. The oil sands is a mainstay of the Canadian economy, and as such, critical to Canada's GDP. Joselito and I had a few exchanges as well, and then he capped off the exchange with a question, how do you feel about CVE? And in fact, he said it's my largest ONG position right now, and I would consider selling others, like for instance, ExxonMobil, doubling it from there. So a lot of people are very confident on Cenovus Energy. So who is this company and what is it all about? So I already gave you a little preamble saying I was hesitant to cover it for a variety of different reasons, but let's take a look at Cenovus Energy in a little bit more detail. I'm going to be as unbiased as I possibly can and just share with you the information as I retrieved it from a variety of different sources. So the first thing that's noticeable or notable about Cenovus Energy is, much like most other energy companies, if you go to their website, almost every single slide in this little banner here has something to do with 2020 environmental social governance reports. Read our 2020 environmental social and governance report, etc. And as the banner slides change, it's more and more environmental related stuff. Now, I understand and appreciate, and I have sympathy for the energy companies, because they have to fight these green lobbyists and activists, and some of them are well-funded nonprofits. So I have deep sympathy for them in terms of the position that they're in. But that being sort of besides the point, let's look at the actual fundamentals of the company very briefly and see where we go. So as I said, this is not necessarily current. I'm not sure if I took this snapshot on Thursday or Wednesday of this week, but anyway, it was trading about $13.50 when I did. It's not a small company. The market cap currently about $27.5 billion. The PE ratio, people who've been following me will know that I find a PE ratio of greater than 15, maybe not necessarily too high, but certainly a little bit questionable. I want it to be, again, I want the companies that I open a new position in to have a price earnings ratio, typically of maybe in the teens or so. So 46 is a little bit rich from my point of view, as a general rule, but there may be reasons why the price earnings ratio is 46. It's not too heavily held by institutions, and obviously you'd be absolutely crazy to short CVE at this stage of the game. Looking at the chart here over the past 6 months, it's been performing really, really well, especially since last year, August, September. So let's take a quick look at the balance sheet, because you guys know by now This is where I go to get my fundamentals information. What we're looking at here is quarters. So Q4, Q1, Q2, Q3. So the last reported quarter was September 30th. Cash and equivalents, 2 billion. Total current assets, 9.5 billion. Right at the bottom of the page or the screen. Total current liabilities, 7 billion. Now, the first ratio we look at here is the current ratio. The current ratio shows you the ratio between their current assets and their current liabilities. It's favorable when it's greater than 1. And in this particular instance, you can see it is easily greater than 1 because the ratio would be 9.5 to 7, which is probably about 1.2 something, maybe 1.3 to 1. So very much in Cenovus's favor. The other thing that you can look at is the quick ratio. The quick ratio is a look at cash and equivalents. And then you look comparatively at current liabilities that are due for payment, say within the next 30 days or so. You can see right at the bottom here, the current liabilities. Current liabilities generally means payable within the next 30 days, 500 million, 2 billion cash. So the quick ratio is almost 4 to 1, very, very much in favor of Cenovus, very strong balance sheet. If we look at the annual balance sheet over the last 5 years, a couple of things that are interesting here, and you can see the actual total current assets. And I'm focusing specifically here on the far right-hand side, which is the last reported annual report. Now, 2020 was a little bit of a tough year for almost everyone. So you can easily explain away the fact that there is a decline in total current assets from 2018-19 into 2020, obviously because of COVID and the pandemic and all the energy stocks crashing. And if you look at the liabilities and we look at the total current liabilities year over year for the past 5 years, once again, you can see that it's current liabilities currently is sort of in the same range where it was 5 years ago. So pretty good. There's been a little uptick in debt. Debt is worrisome or not, depending on how you use it. Corporations call debt leverage, and many corporations are highly efficient at generating more revenue and more profitability using other people's money, which is different to consumer debt. If you are carrying loans for things like a house, which is a liability because you pay for it every month, personal expenses, whether it be student loans, cars, or whatever the case might be, that's not good leverage or debt. That's bad leverage. For a corporation that actually can use leverage in order to make more money, debt isn't necessarily a bad thing. Let's look at the valuation here, a couple of snapshots. Because Cenovus is in the oil and gas consumables fuels industry and has positive earnings, the price earnings ratio and the price to book ratio are the most appropriate. So if we look at the price earnings ratio, we already briefly discussed that. So even though it seems high at around 48, it's actually below the industry average. So it's actually not that bad. So if you wanted to open a new position in Cenovus, that's certainly one of the things you want to look at, but you don't want that to be sort of the proverbial Chinese wall that prevents you from looking any deeper. If we look at the price to book, 1.4 times compared to the industry's 3.5. This company, as a general rule, looks pretty good. The dividend, it pays a little dividend. I don't think if you're a dividend investor and you need some fixed income or whatever, you're going to look at something like Cenovus. But ironically, many companies in the oil and gas and consumables fuel industry don't even pay a dividend. So the mere fact that you can actually achieve a bit of dividend growth is a bonus. How about the growth rate analysis? Well, this is an interesting picture. Recently, the earnings trading, I beg your pardon, at CVE has been positive over the 12 months. Over the past 12 months, the company has reversed the prior period's loss. Well, that kind of makes sense. To show a profit of 27 cents a share, it's a pretty good performance. This performance was to be expected as it was typical of companies in the oil, gas, and consumable fuels industry. Now, if we look at the actual earnings per share growth, TTM, trailing 12 months, 120% compared to the industry's 98. So an outperformer here, a little bit of an outlier. But more importantly, look at the revenue growth over the trailing 12 months, 144% uptick compared to the industry's only 34%. I think in the general scheme of things, people will probably be happy with 34, but look at Cenovus at 145. Financial strength, we look at the debt, and you can see that the debt to capital ratio is about the same as the rest of the industry. It's very, very manageable. So I discussed the quick ratio and also the current ratio a minute ago. The current ratio, as a result of the total current assets versus current liabilities, is greater than 1. The quick ratio from a cash point of view at the time of this report, which was at the end of September, was a bit short, but now it's actually greater than 1. It's in a pretty good position. In addition to that, the interest coverage for CVE is 2.42, and with almost 2.5 interest coverage for the most recent quarter, Cenovus would have no problem whatsoever to repay its debt. Our friends at TipRanks indicate that Cenovus is a strong buy for us, and they have an average price target of $16.73. So digging a little bit deeper than the 14 analysts covered by TipRanks, which are mostly US analysts, I found a total of, over here we have 22 analysts that are actually covering Cenovus. 4 of them say it's a buy, 17 outperform, and 1 say it's a hold. This information is extracted from Morningstar, from my Canadian portfolio. So it's interesting that there's a little bit of a deviance there, but at the end of the day, when you have 21 people saying buy or outperform and only 1 saying it's a hold, no one for sure is saying it's an underperformer or a sell. This looks like a pretty solid stock to me. This is Cfra, and Stuart Glickman, who's a very well-known analyst and actually someone that is worth a listen to, rates it a 4-star buy. It's got a 12-month price target of $14. And I enlarged this little section over here because it's good news and it's interesting news. We recently raised our risk, we being CFRA, recently raised our risk assessment from high to medium, reflecting CVE's acquisition of Husky Energy. Husky Energy, for those people who don't know it, is another Canadian energy company headquartered in Calgary, Alberta, in Canada. And Husky, just from a consumer point of view, is the actual fuel supplier to all Costco fuel stores throughout the United States and Canada. So if you go to your local Costco to fill up your car, you are actually pumping Husky Energy. The deal introduces more debt and a potentially less efficient partner, meaning stated annual synergy expectations, $1.2 billion, are at risk of underachieving. We think that the longer-term risk has been lowered as a result of the acquisition, considering a reduced exposure to heavy oil discounts, but near-term price appreciation will largely depend on a demand-side recovery. CFRA says our recommendation is a buy. I've highlighted just a couple of things from their latest report on CVE. They said the realized pricing has been strong. Obviously, we know that. That's true for the entire industry. The acquisition of the former Husky adds meaningful refining assets, which serves as a hedge if takeaway capacity from Western Canada is pressured. We think the near-term focus for management will be debt reduction, helped both by strong operating cash flows as well as targeted sales of non-core assets. Our 12-month price target of $14 reflects a 4.4 times multiple of enterprise value to projected 2022 EBITDA in line with peers. It's paying a dividend. They may increase the dividend, which they might double, which will increase the yield of 3.6%. So guys, that's kind of a quick snapshot on Cenovus. I don't have a position in Cenovus Energy, and I'm going to suggest to you here without taking too much of a leap of faith that Cenovus is a buy. I understand that for some people in our community, it's a strong buy, but yeah, I would not think anyone putting some money into Cenovus Energy has proverbially lost their marbles. So on that note, guys, this is a wrap on Cenovus Energy. If you like my content, please remember to subscribe. And of course, I look forward to your comments, because as I've said many times before, your comments are frequently more valuable, more entertaining, and more educational than my videos. So thanks for watching up to here. If you have a position in Cenovus, maybe you can tell us why and where do you think it's going as opposed to where the analysts think it's going. And if you don't have a position in Cenovus and it's something that you might be thinking of opening a position in, let us know as well. It'd be interesting to hear your thoughts. I look forward to speaking to you. Bye.